Salt Lake City's apartment market continues to see a lot of up and down movement, but none of the downs have been especially extreme, so overall fundamentals remain in very good shape. Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons, your Salt Lake City update. The best news out of Salt Lake City is that the economy remains very hot. The metro has added about 20,000 jobs in each of the past 2 years. In 2012, the employment base grew 2.6%. That was more than double the national average, and it was 14th best nationally among the core 100 metros. So the Salt Lake City employment base is fully recovered from the losses it saw during the recession, and the prospects going forward remain very favorable, as Salt Lake City has done a good job drawing some employers out of California who are drawn by Salt Lake City's highly educated workforce, plus the lower cost of doing business. And before we talk apartments, though, we should point out that the for-sale housing market has also been boosted by the economy. Home sales jumped 20% year over year from 2011 to 2012, and prices climbed about 5%. So that helps explain why the apartment stats aren't as even better than they are, though they still are very, very good. Occupancy always tight here, and it remains so at the end of 2012, even after a 100 basis points quarterly slide down to 95.9%, still very tight, and that's still up 30 basis points year over year, and every submarket and every product age group is above 95%. And rent growth levels have bounced around a little bit, but they are still strong. Annual rent growth hit 5% in Q1, then down to 2.8% in Q2, then up to 4.6%, and now down to 3.5% annually as of Q4. But that's still 50 basis points better than the U.S. average. And there's quite a lot of variation by submarket and product age group. Let's highlight the product age categories for you, and you can see that the newer apartment stock is really what held back that overall number. Hikes of around 4 to 4.5%, units built in the 70s, 80s, and 90s, but just 1.3% year-over-year growth in that 2000 plus segment. And that traces to the fact that Salt Lake City was still adding a lot of apartments later into the recession, when most other markets had seen a slowdown. And after a very brief slowdown for Salt Lake City, we saw construction pick up very quickly again. So there are another 2,114 units scheduled to complete in 2013, which would expand the apartment base 2.6%. And that is scheduled to be the 6th fastest clip nationally, behind only Austin, Charleston, Nashville, Raleigh, Durham, and Charlotte. And here is one submarket highlight for you to wrap things up. Downtown University led the metro with occupancy at 97.8% as of Q4. That's up 80 basis points year over year. And it also topped all other submarkets with annual rent growth of 4.7%. And we are seeing a pretty sizable chunk of new construction in the downtown University area, but that probably won't weaken the fundamentals too much here. And overall, we expect 2013 to bring better revenue growth than we saw in 2012 for Salt Lake City, largely because the economy has been so strong and should continue to be. We're forecasting occupancy to climb 80 basis points to 96.7%, and for rents to climb 5% year over year. And that wraps it up for Salt Lake City. So until next time, for Apartment Market Dynamics and MPF Research, I'm Jay Parsons. Thank you for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.